this video, we are going to learn about what are climate risks and how they impact financially companies, their financial impact on different organizations. And we are talking about corporates here. It is a very important topic, trending topic, in 25, now in 2026, and also going further, it will be very important to understand the climate risk, how climate change is throwing us all kind of risk which we call climate risk, different type of climate risk, and how they are impacting the companies, right? So let's just dive in. So we have two type of climate risk categorization, standard categorization: physical and transition, right? What are physical risks? Physical risks are the risks which are, which have arisen from your extreme weather events. Which are extreme weather events can be, simply floods, right? Wildfires, hurricanes, cyclones, increased sea levels are there, melting ice caps in glaciers, melting glaciers, and other climate shifts, droughts, etc. The different kind of activities which we hear about a lot in news these days, and the climate change has been attributed as the main reason for increased frequency of these activities. And all these activities, they come with different risks to individuals as well as corporates, companies as well as governments, right? You can see them at every level, each level. Right. So here we have hurricanes, floods, etc. So all these kind of risk, how they impact a corporate. Suppose your manufacturing unit, you manufacture, say, for example, some sort of fertilizer, and your manufacturing unit is situated in the floodplains of a river, right, which is a major river. And in the summer months, because of heavy rains in the catchment area, the river floods, and the flood water enters your manufacturing unit. Till few years back, there was no such situation because the river had some carrying capacity of the water. Now it doesn't, because of the silt has accumulated, various reasons. Also, the erratic weather events, which means the very heavy rain in very short span of time. In India, we sometimes call them as cloud bursts also, right? In the mountain region. So that has happened, and the flood water, suppose, has entered in your manufacturing unit, which has damaged, number one, overall your unit, the machinery, raw materials which was kept there has been submerged, production has stopped, electricity is not there, right? So all sorts of things have happened, and you have analyzed that it will take for your teams to get back your manufacturing unit in a running state. It will take 20 days, right? So 20 days of production has halted. You will have to pay your labor, so that's an extra expense, because the production is not happening. It is sort of adding to your profit and loss as a loss, for example, right? As an expense, let's say, right? It is an added expense also, because you have to spend money to get your manufacturing unit to in the up and running state. So that's what physical risks do. Transition risk, on the other hand, they are the financial consequences, right? The financial impacts from the global shift towards a low carbon economy. Now, you can link it with 2050, the net zero pledge that many countries have taken, many companies also have taken. They want to be in the net zero state. They want to take their operations as well as value chain in the net zero in terms of greenhouse gas emissions on or before 2050, right? So, in order to get there, companies have to take tough decisions. Governments have to come up with a lot of regulations so that they can, regulate the industry, and they can ask the industry to shift to, green technologies, low carbon emission technologies. And this will take some mandates, some regulations, right? Some compliance, some strict action. So it is a necessary evil. Transition risks are necessary evil. You have to do it, right? You may gain, so it may present some sort of opportunities in the long term, but in the short term, yes, it will have financial impact, because if a regulation comes, you have to prepare for that regulation, and that will need more costs. right? More expensive. For example, CSRD, it's a regulation, it's a disclosure regulation in European Union, right? And it also asks you to disclose about some information, some tangible information about your climate risk that you're facing. Or for example, TCFD, right? So you will have to, in a very simple manner, if you don't have a sustainability team or if you don't have an expert who knows how to report uh, against CSRD, you will have to hire a consultant. You will have to also hire inside your team. So that's an added expense, right? So that's a very, very, very simple example. But yes, what are transition risks? We have seen these are the regulations, these are the taxes, carbon pricing, carbon taxes also. Government may or industry may introduce taxes on your carbon emissions. It will say that above a certain threshold, if you emit annually your greenhouse gas emissions, you will have to pay the tax. For example, the limit is, and it's already happening, right? It's already happening in terms of say carbon credits. There are regulations which say if you are, you know, emitting greenhouse gases, you have to purchase carbon credits, which are sort of, promoting some sustainable activities or climate greenhouse gas emission reduction activities in some other area. You have to purchase those carbon credits by paying money. So that is also a cost, right? And shifting consumer preferences will be there. Consumer shift is already happening. We all want sustainable products to use. We all want products which are not resulting in a lot of greenhouse gas emissions, and that will happen at a very rapid pace. And we will be ready to, spend more money for more sustainable products. So if you as a manufacturing unit, if you as a company are not, sensing that demand, sensing that shift, your products will go out of demand, right? And it will impact your business adversely. Your facilities may shut down in the future, so your business will be completely impacted. So that's what physical risk and transition risks do, right? Now, the some statistics which I want to talk about here is about the $1.2 trillion annual cost by 2050s for major companies, which has been projected by S&P, right? It's a well-known firm. So they analyzed 1,200 firms by 2050s. So they're projecting that by 2050s, 1,200 firms, based on the data of 1,200 firms, annual physical risk cost will be $1.2 trillion dollars if they don't change. And it is written here, without proactive adaptation measures, extreme weather events and asset damages will escalate the financial loss. The example that we just discussed about the manufacturing unit situated in floodplains is the same thing that they are saying, right? It is a financial loss to a company, and if you, sort of expand it, at a macro level, right? This is the kind of losses that we are, that we fear that we'll lose, right? So that is currently happening. And after that, in the next video, we are going to read about more about transition risk and then climate risk and other things, right?